We think that we're more in a lower return environment, Dom, going forward at a 4 to 6% total return for the S&P 500. Couple of reasons for that. One, the Federal Reserve is raising rates. Rates have been below the rate of inflation for close to 10 years, and now we're starting to see that move higher. The trade-related issues of $200 billion on, let's say, a $20 trillion U.S. economy really is not a whole significant amount. So Larry Kudlow is correct in your previous segment that this isn't going to affect the U.S. economy, nor will it affect earnings right now. But be careful, because it can, and this could accelerate real fast.
So why are all these CEOs, especially on the retail side of things, saying this is going to hit the consumer? Consumers are going to feel higher prices. Maybe if I'm playing along with the president's plan, I take a little higher cost item and I pay a little bit more, and it's better for the U.S. in the long run from a trade negotiation standpoint. Are these CEOs correct in sounding off as much about passing all these costs on to consumers?
Without a doubt, they are. It's just that you haven't seen a great amount of inflation on the cost side yet, i.e. these tariffs. So we're in the early innings of this. But the CEOs are 100% correct. For example, a Walmart, for example, that's a low-margin business model. Their operating margins are 4 to 5%. So if they get an increase within their goods, they're going to have to pass that along to their customers. And that not only goes for retail, but that also goes for industrial, and go down the list.
So you brought up these sectors. You're a portfolio manager. As you talk about the way that these cost structures are evolving, given what we know about tariffs right now, the little that we do, does that mean that you have to change the way that you look at investing? Are you looking at certain parts of the market that are more attractive than others because of that particular cost pressure that's building for certain industries?
So we haven't been that terribly concerned as of yet, but we are concerned that this overall, the U.S. economy and the global economy will start to slow down if this gets to be more of accelerates in a certain level. So we would stay with more rising dividend companies, consumer staple companies. We would go with the Walmarts of the world. You just want to be with the steady eddies at this point in the market cycle. You've had, Dom, growth stocks on a tear. As we all know, and we've spoken back before, you want to move more towards low volatility value companies at this point.